Regional banks, as we mentioned, the biggest losers in today's action. Zion Bancorp, Western Alliance getting crushed after both banks disclosed problematic loans in their portfolios, raising concerns over credit quality and potential charge-offs. Those stocks sending the regional bank ETF KRE sliding nearly 7%, its worst day since April. For more on the troubles facing the group, we're joined by Chris Marinac of Janney Montgomery Scott. He is the firm's director of research. Chris, great to have you with us. You heard Rick and you heard him talk about SOFR. How does this connect? When you take a look at that graph and you take a look at the action in regional banks, it doesn't paint a pretty picture. What's your take?
Well, today it's a negative picture because of the explosion of SOFR and these concerns. I think that we've seen SOFR go back and forth many times, including back in April. If you go back to 2023, we had a lot of chaos for a few months, March, April, and May, and then we gave all of that negativity back and we rallied from that. Because the fundamentals of the banks are they have a lot of capital and a lot of reserves and a lot of earnings to sort of handle this noise. I agree. I don't think that it's idiosyncratic or one-off. These things are going to happen. Credit is not pristine, nor should it be. The banks are levered 9, 10 to 1. They're going to have errors and they're going to recognize them. I think a lot of the negativity for banks tends to be unfounded because it's a very short cycle of recognizing the issues and then moving on to the next task. And I think the task for most banks is to continue to make money, buy back stock. And I think the tightening of credit is going to be temporary. I think that, as Rick mentioned, collateral builds character, and that's always been true in banking. So I think we're going to see that the better borrowers can get access to capital, and those who are going to struggle are already struggling. And I think that many of the banks have less leverage heading into this cycle. So I just don't think it's going to be as ugly. But days like today will happen. It's just part of the game for banks.
Yeah, Chris, I hear what you're saying, and I would agree wholeheartedly if the KRE was coming off from an all-time high, but it's not. This is an ETF that made an all-time high in February of 2022. Obviously, the S&P is significantly higher than that. The larger banks are much higher than that. They've underperformed. And, oh, by the way, these are the banks that should be theoretically doing well if there's going to be all this M&A activity that everybody is hoping for. So why the continued underperformance, forgetting about just the last week?
Well, for one thing, Guy, I don't think that the whole sector has reported enough earnings for people to see where the whole capital stack is. I also think to some extent we've seen companies like Fifth Third a month ago recognize almost 100% loss on Tricolor, raise their dividend 2 days later, and then buy Comerica a month later. So there are ways to self-heal the process. I think there still will be M&A, and I think there still will be progress in the banks. The stocks are off because everyone sort of crowds into the same trade temporarily, and it works. It worked beautifully today, so that's great. Tomorrow's another day. I think you'll see these stocks rally on the back of the fundamentals and a little cooling off of these concerns because there isn't likely to be 20 problems that are like Tricolor, First Brands, and others that have popped up. There will be more. I'm not saying it's zero. I just don't think it's going to be a plethora because we're at a different phase of the cycle where some problems emerge, but it's still going to be relatively limited.
So even with the explosion of private credit, Chris, you don't think that the loans that have been extended and made are any worse in quality to companies that maybe you have a worse balance sheet? I mean, I'm just trying to figure out, how you have such certainty that this problem is going to be less. I understand on the bank side of things, their balance sheets and their leverage, their balance sheets are much better. Their leverage is much lower than previous cycles. But at the same time, you have, on the other hand, an explosion in private credit where there's so much money flowing in and there's just a reach for deals and loans to be made.
So I think at the end of the day, the credit answer is it goes back to frequency and severity. How many problems, that's your frequency, and then what's your severity of loss? When you have fraud like Tricolor, the severity is almost 100%. When you have other situations like commercial real estate, it's a lot lower. Things were not as ugly at New York Community, now Flagstar, than people thought a year and a half ago. And I think that'll play out in some of these other concerns. On private capital, they are lending a higher leverage for a higher interest rate. The banks are sort of being blamed and labeled into that when the banks are really lending on lines of credit with a much better security position. I think a lot of companies are doing senior secured deals, and yes, they will be hit by fraud. Those fraud incidents will be painful, but they'll be few and far between. I think the structure of how private capital is tied into the banking industry is going to ultimately be better than folks understand. But it won't be perfect. It will have some issues and some bumps and bruises associated with play.
You gave the example of Fifth Third as self-healing, Chris, and so I'm wondering if you go out on a limb and you say, Western Alliance is a buy or Zions is a buy?
Sure. I think both of those stocks can rally. I think you're going to see that they both build capital. Most of the mid-sized banks have built capital 100 to 120 basis points since Silicon Valley failed, and their shares have gone down in terms of both price, but also the share count has come down. Many banks are buying back stock hand over fist, and I think days like today actually encourage CFOs to buy back more stock, which I think will be another theme that comes out of this episode today.